All right. With that, I will turn it over to Adrian. And actually, let me first of all ask, would somebody be willing to be the main moderator today? People, if you have questions, feel free, like always, to put them in the chat. But I wouldn't mind if somebody could take over the duty of judiciously interrupting and reading the questions.
I can do it for you, Daniel. No worries.
Sure, you're sick too. All right.
Yeah, I
Hey,
can do it
Adrian,
as well then.
do you want us to jump in, at certain points? Do you want us to just queue them up at the end? How would you prefer?
It's okay if you guys want to jump in. I will, I'm really pretty free flowing and love a little discussion. I love what you guys talked about at the beginning, that you just kind of had an open forum. I love that kind of. I think that forum is a really good way for everybody to learn. So, and as you're going to see in a second, and as you can see here from my title, my history is as a scientist. So we tend to use acronyms without explaining them to anyone. So if there's a little bit of that as well, this isn't going to be a scientific talk, but some old habits die hard. So
Hey, Adrian, one more quick announcement before you get started. I've been talking with various speakers who want to come in and pitch deals, and I'm getting the framework set up to do that. One of the complexities in doing that is that a lot of the people that pitch deals could only talk to accredited investors. And so we're going to set up soon a sub club, as we had talked about earlier, for accredited investors that want to hear pitches. And I know that we had talked about a couple months ago making that on the same Friday. So I just wanted to let people know that that's going to be coming soon. We'll dedicate one Friday a month specifically to a pitch, and that'll be open for accredited investors who want to listen to it. I'm open to suggestions too about what we want to do with those that aren't accredited during that time. I know that the law requires that only accredited investors be there, which is exclusionary, and I don't like it personally, but that's what the law is. So I'm open to ideas for non-accredited investors during those as well. Thanks. I'll turn it over to you, Adrian.
great, Daniel. Thanks. I actually have a suggestion there. So as you know, a direct pitch can only go out to accredited investors. However, if you establish a relationship with a non-accredited investor or have a call with them, you are allowed to talk to them about a deal. So one thing you could do is aggregate those people together, have a one-on-one webinar that's more in this format, and then they would be able to subsequently establish a separate relationship with that sponsor, and then have the potentially the ability to participate, if not in whatever that deal is right at that time, certainly in the following one. So it's a good way to kind of grow that investor base for the sponsor, and also grow the opportunities for those who are not accredited. Because I feel very strongly the same way you do, that I don't like that it's exclusionary. And I lived a lot of years where I had the acumen to invest in a deal like this, but not quite the net worth. And I think that it's important that the opportunities are extended to others.
I think it might be a good idea too, maybe just to have a Friday dedicated to what are the SEC rules and how can we navigate them in order to bring the most benefit to the club. I just have an open discussion on that too, just so everybody's informed on the topic.
I'm falling in love with this club in just 10 minutes. So I think the idea is great, and I love the communication that I've heard thus far. So I will, with that, I will go into my talk. I only have about 8 or 10 slides here, and I wasn't quite totally sure of the forum, so I thought I would just sort of tell my story, how I got to kind of where I am now with my partners, and what the journey's been like, and also talk about some of the key lessons that that I've learned and we've collectively learned along the way. I think that those are things that we're always trying to remember. I've actually started to create a little list of these things, and I have this goal to read them all every morning so they stick in my mind. I don't do it every day, but definitely it's a good idea. So I thought some of those key takeaways would be interesting for a group to hear and know the origins of where some of those things came from. And then, you know, for somebody who has interest in investing, but also someone who has interest in starting their own, you know, their own portfolio, or maybe they want to be a syndicator. I think some of these things are, you know, are good lessons to bring forward in that regard. So, let's see if I can control these slides here. There we go. Again, my name is Adrian Cooper. I am a co-founder and principal of SWB Multifamily. Our group has over 1,000 doors in the DFW area. That's where we focus. I'm actually based in San Diego, so I'm here on the West Coast. I think, like many of you, I'm sure if you had over 200 talks, you've talked to many people who had a background in some field and then got into real estate, or wholly or partly, and that's the same story that I have. I am a scientist, sort of like the military. Once a scientist, always a scientist, and worked in R&D and preclinical R&D for many years. I worked on oncology and inflammatory disease. My last W-2 job, I worked in organ transplant on fascinating projects. We were doing genome engineering to make humanized pig lungs that could be transplanted into humans. Some of you may have heard this story about a pig heart that went into a human. It happened again this year and once at the beginning of last year. And my group were the ones who did the genetics for those pigs. So a big proud moment for sure, and awesome to have been part of something so special in the past. And I'm happy to answer questions about that in another talk or another forum, but really cool and exciting work. I was biochem in undergrad, but my specialty was in cell molecular biology. But also, and I think the most the critical thing here is that as a scientist, I was a big data head. And just like a lot of you guys, I assume there's plenty of engineers on this call as well. And, you know, you have some really strong strengths with numbers. I think, you know, my biggest strength is I'm really good with taking sort of large data sets and mining out meaningful data, and also taking that data and packaging it up into a consumable form for others to look at and understand. And I think that skill translates across many disciplines, particularly to the financial side of real estate. You're really doing a lot of those same things, just taking large data sets and sort of massaging them and trying to understand what you can learn from those. I'm from Illinois originally, which is why I have the Midwestern accent that gets made fun of quite often. And I'm currently in San Diego, as I said. I'm also a people guy. I like to talk about, you know, my own interests outside of business. I'm an avid traveler and could talk about traveling for days and days on end. I visited quite a few countries. I've had a couple of, you know, long-term travel backpacking trips that I love to talk about. I speak Spanish and Portuguese, and I'm okay with English sometimes. And I love any outdoor activity. Really enjoy cycling, love hiking, love being outdoors, which is why I'm living here in San Diego. So if any of you find yourselves coming this way, looking for some tips on some things to do in Southern California, or if you're based here and you wanted to get together, I'll be happy to meet up. I think at the bottom here, I just made a little graph. It's always funny to me to look at this thing. Sometimes I'm tempted to, you know, move the x-axis all the way back to like 1999 or something, just to emphasize how, you know, growth is really exponential. And I think that you know, once you sort of pour gasoline on the fire, things can really take off. And a lot of what I'm going to talk about here today follows that theme. And so, you see here that I basically, personally had, didn't really have much real estate. I bought a single family home in 2017. Can't even see that on the graph here. And then after that, things really started to pick up, as you can see, in 2021 and beyond. And so we were fortunate to, or I was fortunate enough to have some really, exciting and strong success very, very quickly. But the truth is that although a lot happened over 18 months, the foundation was really set many, many years before, long before 2017 even, as somebody who was just very interested in investing, finance, all those things. I had started building a foundation to be able to do some of these things, long before it was ever in my mind. And so I'm really just going to kind of take you guys through my real estate journey, and talk about some of the key milestones that happened over the past, 6 or 7 years, and some of the mountains we had to climb, and some of the great things that happened, and some of the difficulties, and again, what I learned from them. But my journey, I'm gonna go into some detail on some of these points and not so much on others. But the journey really started for me back in 2017. The very first purchase I made, real estate purchase at all, I didn't even have a primary residence. I still don't, by the way, which is something that always surprises a lot of people. But since I live here in SoCal, my feeling has always been, as a numbers guy, to be as efficient as possible with all my dollars. And so a lot of them go, as you guys heard a minute ago, into Texas. So I'm going to talk a little bit about these early years, maybe a little bit more than the latter years, because I think where you came from is often the most important part of the journey. And so I had, way back in 2017, been approached with a syndication. It was the first time I had kind of heard of syndications, but it was the first time somebody ever gave me the opportunity. And the truth is, I didn't fully understand it, and I do have a really what's the word I'm looking for? I have a core value that I do not invest in anything until I fully understand it. And I think that's something I always tell LPs. We were talking a little bit earlier about non-accredited investors or even accredited investors. Sometimes folks don't really understand. So I like to sit down and, make sure and walk them through. But if I feel like someone doesn't understand or can't follow all of the numbers, I really suggest them not to invest. I think it's worth taking your time and being 100% absolutely sure. What I did then is I actually reached out to a very, very close friend of mine and asked him to help me understand the OM and go through the pro forma and some of the terms in it. And that ended up turning into one of the better decisions I made in this entire process. He not only began to kind of coach me and take me under his wing to explain that deal, but it turns out this is a guy I knew from college. He had been, working in commercial real estate for 20 years at that point, and he actually teaches an MBA commercial real estate course at Emory. And so he began to share course materials with me, and I just started to eat it up. And it really is where I started to really build my foundation. At that same time, I did have a few bucks and I wanted to start investing. So I bought a single family home in the Houston area. So that was really my first unit. And I still have that house. It's still sitting there. And sometimes I think about how it is zero work. And that's a little bit of a win, considering the effort that it takes to manage, over 1,000 doors. But I think that finding him as an expert and learning everything I could from him was another, just critical point in this entire process of my trajectory. The following year, he actually had that same guy He had a commercial retail deal that he was doing in Tampa, Florida. I invested with him as an LP. So, one of my first LP investments was with someone that became a mentor to me. And so he really had walked me through it. It was a trusted friend. And I think that's, tantamount to what you should be doing as you're starting your journey. Finding a good source you can trust and learn what you can. The other thing here is you see, coming into 2019, I was offered this opportunity to build some spec homes. And, that actually came from someone that I had met many, many years before, and I'd done a spec home with him, and where I basically borrowed the money, he did all the work, and I got, 10 grand out of it or something like that. And which was super exciting. It was a lot of money to me at that time, especially. And he had always been coming to me and asking if I wanted to invest in another one and wanted to do it again, but I never had the time or the money, or wasn't in the right place. Well, he came and he said, hey, we have these 10 lots in an area near Austin, Texas called Horseshoe Bay, for those of you who are from Texas who may know it. And he said, we have 10 lots. Do you want one or two of them? And I actually said to him, I would like them all. I'll take them all. I think all I've been doing is having all these conversations with people who say they want to get into real estate. They say they want to, hey, we should get our funds together and start investing and stuff. But nobody ever does it. And I felt like, oh, this was an opportunity to start that. So I told him I wanted all the lots. He would only give us half. I founded this company called Financial with a very, very close friend of mine, and we decided to do our first syndication. And so in the end, they kind of cut us back to 3 houses. And so we had to go out and we raised money for it, and we opened the bank accounts, and we, got an attorney and figured out all the way to structure everything, and, how to get a subscription agreement together and a private placement memorandum and all the work and everything we had to do. And about 3 or 4 months later, the whole deal got canceled because there was a small city ordinance that prevented him as a builder from selling more than 3 lots if you owned more than 5 in a 2-year span of time. And so, unfortunately, the deal fell through. It was really heartbreaking. We were so excited about it. We had gone out and talked to investors, and we had spent probably $15,000 in the process as well, on legal and other things. And the whole thing went away. And the reason I spent some time on just this particular part is because I think that there was some really important lessons from that. I gained some valuable insight on legal structures and documents, established an investor base. And to this day, every person who was in that deal has been in every single deal I've done ever since. And I think that, there are not really failures sometimes, but rather, there's just this learning experiences that you have. And I think going through that process really set me up for what would come 2 years later. Though I did not know it at the time, it really was the base of the entire thing. And one other thing that happened in that time is I had to get approached about investing as an LP in an investment in Lexington, Kentucky. For those of you who are adamant followers of some of the folks in the real estate space, this was a Jake and Gino deal. They are sort of well-known multifamily investors and have a big podcast and all these things. And so in that deal, this is the second thing that set me up for later, is that when they would send out their financials, I would go through them with a fine-tooth comb, and I'd go back with questions. And I started to build my own charts and graphs for them for easier display. And what happened is their accountant, I would send them back to their accountant. And this guy became very impressed. He was like, this is amazing what you're doing here. I'm going to bring this to these guys. I think the way you're organizing this data is really valuable. And so I stood out to them. And I think that it's important. Another key takeaway here is I started to find a way to leverage my skills to support a sponsor, even though I was a limited partner in that deal. And I think that went a long way. And I'll just tell you, it's not in this timeline, But a couple of years later, when these guys were doing another deal, we as SWV actually did a joint venture with them, a property that we still hold today, that is in Tennessee. And all of that came from just the effort that I had put in, years before. So it really goes to illustrate what comes from leveraging what you have and what you can provide to support a sponsor. So I think that was a really important moment for my own personal growth.
Hey, Adrian, before you jump slides there, a couple questions we got popped in. I think one of them you already addressed, but I'll start with the first one, which is Manju's asking, how are you managing your single family home remotely?
Great question. So that single family was a turnkey. And so I have a third party company that manages it. They're called Real Property Management Preferred. If you're looking for someone in that area, I would strongly recommend them. I thought they've done great for me. It is zero work. I would say I've probably done more in this last 30 minutes than I've done in 6 years of owning that house. so it really is zero work.
Okay, so you got a local property manager who's taking care of it for you.
Correct.
Got it. Okay. And then the second question was from Nick, who said, in this, I guess this is probably referring to the spec home deal. Did you end up losing any of the investor money as a result of, as the deal, fell through?
That was a great question, actually, and I forgot to mention. So the only person who lost any money was myself and my partner. So none of the investor money was ever put to use. So the only money that was lost was ours, and that was all just sunk costs from pursuit costs and startup costs. So no one lost a penny. They just all got their money back after about maybe two or 3 months. I don't remember the exact time.
Thanks.
Great. Feel free to jump in with other questions. I know, I tend to get a little bit wordy. I think a couple of my partners are going to join the call, so I'm sure they're cringing at me having just an open microphone to speak freely. Moving into this kind of range of exponential growth. And one more thing I forgot to mention here is that at the end of 2019, I actually had my first 2 opportunities come to participate as the general partner. And one was a commercial retail deal with the same guy who I did the Tampa deal with. And the good thing was when he came to us, we were sort of ready. We had the spec home thing had fallen through, but it really coincided exactly with this opportunity showing up. So pretty much everybody just redirected their funds over to this other deal, which was great. So, we didn't really have to do much. So that was great. That deal did not close until 2020. At the same time, I had right around that same time when the spec home deal thing fell apart, I was at this time to educate myself, I was listening to a lot of podcasts, and I was listening to, I think it was a Jake and Gino podcast, and on it was a multifamily syndicator who was kind of telling her story, and she started to mention who her partners were, and one of the partners she mentioned is now my partner, Neil Dandona. And Neil and I were actually very, very good friends and had been friends, for 15 years or so at that time. He was located in Texas. The reason why I met Neil, I met him when I was in graduate school. I was doing a PhD back in Houston in the early 2000s at the Baylor College of Medicine, which is a medical school. And the PhD students, the lowly PhD students, had to TA courses for the medical students. I was a TA in one of the classes he was in. We became fast friends and had been friends ever since. So you can imagine my surprise when I hear his name on this real estate podcast. And so I called him up immediately, and we started to connect on what we were working on in real estate. He had been working on some relatively large deals with another group at the time. doing multifamily, and he knows me, knows me as a connector. He is very much the same way, and said, look, the next time we have an opportunity, maybe you can participate. So the second opportunity that shows up here at the bottom was an opportunity to participate in a deal that he had brought to the table, where they were willing to bring to offer small amounts of GP to inner circle folks who were able to bring a large slug to their deals. So, and I didn't write it here, but another good key takeaway is think about your network and, again, what you can bring to the table. Some folks who might not have some of the skills to, maybe you don't have great Excel skills, and maybe you're not really into analyzing deals, but maybe you know a few people who might want to invest with you. And if you can bring a large sum into a multifamily deal, a lot of times there are sponsors, including ourselves, who will offer out some of the general partnership in exchange. And so that was the situation here. I was very, very excited. It seemed like my real estate journey was finally going to take off with that opportunity and the commercial retail opportunity. And then 2020 came, and basically we'd gone out, we raised the money again. We had, all the LLCs and bank accounts and everything you can do. And then that deal also sort of fell through. And, I think that, again, it felt like another false start, and it was a big false start. And again, I'd spent 15 grand or whatever it was. But again, I think I learned quite a bit about in that situation on, what some of the bigger folks are doing, how to create OMs, I was getting better and better at analyzing deals. I think the importance of transparency became very, very clear at that time, too. And so in the end, we didn't do that deal, but I think the biggest takeaway is that the deals, sometimes the ones you don't do are more important than the ones you actually do. And that deal didn't work out, but not so long thereafter, Neil was looking to form a new partnership with people that he knew, loved, and trusted. And I think that basis of friendship, time together, and maybe more important than anything, trust, is the reason why SWV has had so much success in such a short period of time. And I'll touch on that a little bit more, but essentially that led to the formation of SWV. There's 4 partners. Another one of the partners, Rishi Anand, was a college friend of Neil's, whom I had met along the way at some point. So, and then our 4th partner is named Sean Warman, who is his wife's an orthopedic surgeon and works with Neil. And so they had established a connection, some years before that as well. And so ultimately the 4 of us came together. We pursued a deal later that year, and we actually lost out on it and invested in final. But what happens is, when you're going after a deal and you're putting together an offering memorandum and you're doing due diligence, you are, very, very much in the trenches. And that experience over, 5 or 6 weeks as we were going after that deal, countless hours on Zoom, we knew that we had caught lightning in a bottle. There was just this time where the synergy of partners and the values are similar. All those things kind of came together, and we knew that we had this team that could really do some special things, and that bore out to be true. Not so long after that, we had a couple of deals that came that we got under contract just within a couple of weeks of each other. And, we were able to close those deals in early 2021. One was a 71 unit property in DFW near 75 and 675. And the other was in South Dallas. It was 171 unit. And those properties were about $6 million and $8 million respectively. And so we ended up closing on those deals in April of 2021. And so one key takeaway I would say is do not try to close your first two major deals at the same time. It nearly killed us trying to getting investors together and getting everybody across the finish line, all the legal things, all the due diligence, plenty of great little stories in the midst of that process that I would love to go into another time. But it was very draining. But I think one of the bigger things I got from that process is, we had to go out and secure financing. And at the time, in my mind, the idea of someone lending me, $6 million or $7 million just seemed, just impossible. And I remember very vividly the very first time I was going to be on the phone with a guy who was a lender, a VP at a bank, and once I started talking to him for a few minutes, I realized that I knew the deal better than he did. And once I figured out that we have the deal, and if they don't want part of it, they're the ones missing out, then it clicked. And then going forward, I was never afraid to talk to as many lenders as possible. And we really gained a lot of confidence from those two deals closing. So, we really went from 0 to $14 million in assets and 250 units in a very short period of time. Not so very long after that, there was a 260 unit deal that came on our radar. And this was a $40 million deal. I think we were a little bit intimidated by it. For the other two deals, each of those raises was about $2.5 million each, which we felt very comfortable with. But to do this deal at the time, we thought we were going to, have to raise about $15 million, and we were very uncomfortable. But I remember very specifically a conversation that I had with Neil as we were contemplating with Neil and Sean as we were contemplating moving forward with it, and we all felt a little bit intimidated, but ultimately, we all also understood that the philosophy of if we build it, they will come. This is it. This was the opportunity that was gonna project us forward, and we all collectively understood that. And we decided to pursue the deal, and we actually won the deal. And the other thing that was hard here is that this was a very nice Class B asset in a great area in Dallas. There were a number of groups that were very well-established groups that were actually going after this deal. And ultimately, we were the ones that won it. And I don't think I know, and it's also the same reason we had won the previous deals, is that we were able to establish a personal connection with the seller. And I think that had a very significant impact. Also, what we've learned is when we've had interviews with sellers, it's a very common part of the process that we have a very genuine and organic chemistry together. And I think this came up a lot this week as well, that I think that the sellers and brokers can really sense when a group fits together well, even though there's no formula to really give to them. I think that was a big piece of why we were able to win that deal. So it was one of those ones where we're like, okay, great, we won it. And then you're like, oh, crap, now we have to go and try to find the money for this. And, we were, through a Herculean effort by everybody on our team, we were able to, raise up. It ended up being about 11 million. We got more loan dollars than we thought we would get. And we ended up raising about $11 million for that deal. And it was very, very trying and very difficult, but we were able to get there. And so we closed on that deal in October of 2021. And from that point forward, now we were on a lot of people's radars. Suddenly, instead of us calling lending brokers, they were calling us. And instead of us looking for deals were starting to come to us. And that was really the inflection point. In 6 months' time, we had basically gone to, we basically had $55 million worth of real estate that we were managing and owning and operating. And that was enough to really get on the radar of some of the folks around DFW. In addition, both Sean and Neil are based in DFW. So they had a lot of good broker connections, and more importantly, also had a lot of good contractor connections that was allowing us to manage all of the renovations that we had to do and all the exterior work that we had to do as well. And so it became a monstrous amount of work. Keep in mind at this time, I still had a full-time W-2 job, and it was extremely demanding. And I would say that 2021 and 2022 were without question the hardest years that I've lived on this planet, where I was working, just ungodly amount of hours trying to manage it all. And I think there's some good lessons that came out of that as well.
Adrian, so we'll jump in with a couple more questions.
Sure.
Let's see. VC is asking, did COVID have any impact on the deals that were in play? I think that he or she wrote it about the time you were talking through your 2020 deal vetting period.
So what happened during COVID, certainly, I would say the biggest impact is that there was a moratorium on evictions in many cases. And now Texas is a very, very landlord-friendly state, so it's not an accident that, we put a lot of our focus there. And so I would say on operating the deals, not as much. We had some trouble during due diligence at time being able to get into units. But I'd say operationally, we just had bad debt stacking up. Now in South Dallas, this deal here that was 171 units, those courts were still operating and evicting. You could get somebody out within 45 to 60 days, where normally that process is maybe 30 to 45 days in Texas. But we had a very good property manager there who was paid a lot of attention to working really hard with residents. And so we only average, and this is in South Dallas, we only average maybe 1 or 2 evictions a month, where in that area you had a lot more. So no problem there, but definitely a lot more bad debt on balance sheets. And that was really the biggest speed bump at that time. So we did not feel too much hindrance.
Okay, thanks. Next question's from Mario. I guess I'll characterize this as you were telling your story about, I think, building and growing and learning your business and kind of getting through the next tranches of the deal flow and execution. You're definitely, as you said, you're learning a lot. So do you have certain metrics or methodologies for vetting partners in deals, and how, any best known methods or rules of the road or prescriptions you could share there on how you do it?
Yeah, I actually this is another one that came from years before. I worked in a couple of startups earlier in my career, and one of the things that you learn in a startup in pharma or biotech is you learn really quickly who's all in and who is not, and who's willing to put in the extra blood, sweat, and tears, and who isn't. So I think one of the key factors is that every partner needs to have full buy-in. And I think again, just go and do due diligence on any one deal, and you'll find out really fast, who is going to be part of, finding solutions. So, and I think that was something I learned really from my science career. And what I did, and what I always felt like, is you kept those people close, and those are the people you knew you could count on, you knew you could go to. I think that's a big piece of it. The second thing I would say, and this is really, I don't know, it's not a secret, it's just who we are, but we treat everybody the same. So you could be talking to the selling broker, and you could be talking to the owner of the property, or we could be talking to the maintenance guy or the leasing desk person. I think that somebody who treats everybody the same is going to be honest, clear, and transparent like that in all aspects of everything they do. And so you can watch how people interact. everybody knows a story or two about somebody. You go out to a restaurant, they start being an asshole to the waiter, and you realize very quickly, I don't think I want to be friends with this guy. And so I think that trait on watching how others treat each other is a big one. And we had friendships and commonalities, so I was very familiar with the values of these guys. Although Sean was a new friend to me, I think I saw a lot of that right away. And so those are the things I would say in a partnership. And then one more thing. The other one is know your own weaknesses and know what your strengths are. And so, and find somebody who complements those. One thing I would say is that I'm a little bit of a softie. And so I am not the greatest negotiator in the world, but Neil has an unbelievable amount of empathy for everyone. And the reason, another thing he's a master at is negotiation. And I'll tell you that I have very high financial acumen, but my construction knowledge and my ability to envision what you could do with the units is subpar at best. And Sean has a very strong strength of, and he's taught me many times, walking in units. He just has an unbelievable vision and understands the intricacies of bringing these different vendors together and working with them to get that vision executed. Those are big weaknesses for me, and I would never be able to fulfill those roles. And so you find someone that complements what your weaknesses are.
Great advice. Let's see, we've got a couple more questions. I'm based on what you discussed, I'm assuming that these deals you're doing are value add based on the construction conversation you had.
That is correct.
Okay, and from a talent or roles perspective, who's managing the property? Are you doing these managements, or do you have property and asset management teams? Or
that's a great question, which I'm going to get to at the end, but I'll just say it now. So there are, we have third-party property management, but anybody who's out there who, has more than a few units knows that the story I described with my single family is not the reality of every other situation. So we are very, very involved in the day-to-day. We meet with our property managers once at least a week, if not twice a week. And Sean and Neil, who are there on the ground, are visiting the properties. Every property gets visited each week. In addition to the 4 partners that I mentioned before, we actually have three employees. We have Ella Stansel, who is an invaluable person who I met actually from the farmer world. We both worked at that same company. She has a background in contracts and procurement. She is our director of operations, handles a lot of our investor relations, but also is critical in the process of those renovations. She's procured contracts for us to be able to secure to procure materials. It's a big piece of what she contributes as well, and really is a key support person on the ground. We also have Casey Smith, who's our asset manager, who has been working in property management for 25 years and has really been a key part of us having a liaison with the property management teams and the leasing folks that are on site. She's based in DFW and is also, visiting properties daily. I don't know if she's on the call or not. She's probably taking care of some of that work on the ground as we speak. And then we added Christina de la Paz to our team just a few months back to help support Casey on the ground and some of the work that she's doing. Because it's an overwhelming amount, as you might imagine, of unit renovations and make-readies and turns that are happening all at the same time across multiple properties. So that's our team and how where we are now and how we support everything on the ground. And then so I'll leave my answer there.
Perfect. Thank you. Reminder, you got about, let's say 7 minutes left.
Sounds good. I will, there's only about 3 or 4 slides more. So I think that Going into 2022 and 2023, in early 2022, we closed these two deals simultaneously in March, and it pushed us over the 100 million mark. At that time, I was just too worn out, left my W-2 job. Although it was never my goal, I just was in a situation where it was unsustainable. But some people do have that goal, and I think it's fine if you do. But I left my W-2 job and really turned my full attention to real estate at that time. We had a deal go full cycle at the end of 22, and we had a great IRR for our investors. I think early on, it's good to get those quick wins, build some momentum. You can provide capital. 2023 was a very, very difficult year in multifamily, as many of you probably know. The high interest rate environment really, catalyzed a lot of cap rate expansion. Values dropped. Multifamily transactions were way down. And so we didn't have any large. We had one collaborative acquisition in 2023 where we did a prep equity piece. We also refinanced two of our deals, which was a big deal. It's very hard to do if you're aware of the numbers and how things were working in 2023. One of those was actually a cash out refi, which was great. The other was a very small cash in. But we really took the opportunity to build out some ancillary businesses that we had always been talking about that support our portfolio. So we started a warehouse company to support our renovation efforts. I mentioned before, Ella has been a critical part of that, as well as Sean has led a lot of that effort. We also started a new company that provides cleaning services for our properties, that does valet trash and supports some of the other cleaning around the properties, that helps relieve the pressure on some of our in-house maintenance staff. That has also proved to be very fruitful. And so, we really focused a lot on our long-term business plan and building out our foundation in 2023. And it was really nice to be able to catch our breath a little bit, to be honest. I think that's an important thing to do, to always think about that future growth, get that foundation set. The last thing I'll say here, just at the end of this journey, and I think the thing that I learned more than anything these last 2 years, is that nobody knows what you went through. They see, $100 million, $150 million, another deal close, all these things, but it is the time and effort it takes to, as I wrote here, sustain these demands of this growth. It does take a lot of sacrifice. I think the hardest thing to do is maintain your balance in that process and be conscious of it as it's happening. When you're just going from one acquisition to the next, really hard to do that. And if I had one piece of advice to myself that I don't think I did the best with, would be to maintain that balance. It was very, very difficult. So keep that in mind, if you're looking to grow a portfolio. With that, so that's kind of the end of the journey. I'm going to just have a couple slides here, talk a little bit about structure, how we structure our deals, and what you can look for if you're looking at a deal, or if you're looking to be a syndicator as well. I think there's a lot of great advantages for limited partners, as you guys know. You've probably seen some of these. We have people. The one thing I would say here is that it's very common that we have somebody whose major focus is any one of the things on this slide. Some people, they really care about tax advantages. They don't really care about anything else but getting that depreciation. And we have others who are really looking for quarterly distributions, and they want the fixed income. And we have others who just say, look, all I want to do is write a check and get a check back. So you get the idea. I think these 6 things that you see here are critical for LPs to understand, and for you to understand as a sponsor, what people see as the most important things. Here, this goes back to Daniel brought up early in the conversation here, talking a little bit about some of the key metrics in a deal. This comes from a deal that we closed last year, November of 2022. And this is just straight from our OM. And I think these are the key metrics that you want to understand if you're analyzing a deal. One of the things I don't see often from people is looking at your return ratio. So what that is how much of your overall projected return is coming from cash flows, and how much of it is coming from sale proceeds from appreciation. And that's something we really take a hard look at. Right now in multifamily, cash on cash returns are very low. And so it's really hard to get, up to this 35-40% range. But for us, that's a very important metric. And we know for investors, cash on cash is a metric for some. And so this returns ratio is one you want to look at. You get a deal and there's only 10% projected return from cash flow, and it's all coming from appreciation. Well, you're making that sponsor is making a bet that they really might not have any control over, as we've all witnessed with interest rates over this last year. So that's one that I think is an important one to look at if you're analyzing the deal. I think the second thing for sure is make sure that the sponsor has some skin in the game. We've always put 15 to 20% of the equity from the GP side in every deal that we've done. And so that's critical. Another thing is to look at your debt terms. There's fixed versus variable rate. Are they getting something that's competitive in the market? Talk to your other folks that are working in multifamily, see what they're getting out there. You want to be able to compare those deals. And then another one that's always seems to be uncomfortable for some sponsors, but I think it's critical, is you have to understand what the fees are and how the sponsor is getting paid. And that should be very, very clear in the offering memorandums. And so we always put it here in our partnership structure. Typically, you'll get acquisition and disposition fees together, add up to about 3 to 5% of the purchase price. So you'll have, 1% up front and 3% on the back end, and all kinds of variances of that. We typically do 2 and 2. You want to look at for promotes that are in the 20 to 35% range. 35% is unusual in multifamily. You'll see that in commercial retail at times, especially in development deals where there's a lot more upfront work for the sponsors. And then there's usually an asset management fee, which the sponsor doesn't make any money off of. That really just allows them to keep the lights on, pay employees or whatever. And we've traditionally done 75 bips for that. We just changed it to 1% this year. It's really more about administrative costs than anything. And then make sure, Dan, you said this earlier, pay special attention to the expected hold period when you're analyzing a return profile. Somebody tells you they're going to get, the equity multiples up here. Yeah. A 1.8x equity multiple. If it's going to take them 10 years to do it, then that's not a very good return. And so you want to really make sure you understand the balance between equity multiple and investor IRR. So those are some of the key metrics, I think, when you're looking at a syndication.
Hey, Adrian, I know we're right at the top of the hour. So while I'm wrapping up, if you want to flip back to your front page that had your contact information in case anyone needs to write it down. Thanks again on behalf of Daniel and the rest of the club for your presentation. It's been great. Super interested to learn more about it. And if everyone that's still on could please take yourselves off mute and give Adrian a big thank you.
Thank you, Adrian. Great job.
Thank you, Adrian.
Thank you.
Adrian.
Thank you, Andrew.
Thanks, Adrian.
Thank you guys so much.
Thank you.
If there are any questions or any follow-up, I'm happy to answer any. And this has been great. Thanks for having me here. And maybe there's time for a couple of questions before people drop out. If so, I'm happy to answer them.
If you have any questions, folks, feel free to jump on and just ask directly, or you can write them in the chat if you feel more comfortable there. I, unfortunately, am one of those that has to run to a meeting. So take care, everybody. Thanks.
Okay.
Thanks, Glenn.
Thank you.
Hey, Adrian.
Yeah.
I'd love to follow up a little bit with you too. Seems like we have a lot in common in our business strategies. And I know we kind of touched base in our Better Life pod a little bit, and I dropped off of that. So it'd be good to reconnect with you.
Yeah, for sure. I'd like to hear a little bit about what you guys, what you've been up to in this last year, and possible even being kind of part of, maybe part of this group. Even I think this is you guys have a really great forum here. And
it is. I want to build this forum up into a larger group with different active programs, and so I'm definitely brainstorming on how to do that. And I could, I love bringing in educational content, but I need to focus more on strategy in terms of how to drive engagement in different programs that we could roll out. whether that's learning or subgroups or just different ways to interact.
Yeah, I'm
Is
sorry.
the accredited rules only for the raise? So after a deal's closed, you can discuss things, or is it? I guess I don't know enough about.
The quick answer there is that the SEC has laid out protection laws for people that are, according to them, not accredited or what they call sophisticated investors. And the basic idea is that if you're not accredited, if you have what's called a 506c, which is an investment for accredited investors only, you're allowed to publicly advertise it, but you can only take accredited investors in. If you have a 506b, which is a different type, and there's a couple of others, there's 506cf, Reg A's, and other ways to raise money, but these are channels that the SEC allows investors to raise money through. If you have a B, you can advertise only to people that you already know. And so the issue when you have a group is that the speaker doesn't know the people there personally. And so they don't qualify under the SEC rules of having a persistent and ongoing relationship, which is the metric that the SEC uses for getting to know somebody. Now, you all have a persistent and ongoing relationship with me because you're in the club, but not with the speaker who's different every week. And so that speaker legally has to know, are the people that I'm talking to all accredited? If not, the speaker could be found in violation of SEC rules. And of course, we want to protect the speakers. Do you have anything to add to that, Adrian?
Yeah, I mean, what you're saying is accurate. It's basically about, you can talk to the person, but you can't solicit the deal, right? And I think the thought process behind it is that somebody may try to take advantage of someone that they don't know, but I guess you can only take advantage of someone who's not accredited. I don't know why they sort of draw the line that way. But I think that's pretty accurate. So,
but you can be taken advantage of even if you're credited. There's nothing that protects you for being.
It's just that
that's the joke, right?
It's just that if an unaccredited investor, raises a lawsuit, they have legal standing to go after you if you presented the deal to them and you're unaccredited. So you can get into you could lose your ability to raise funds for a deal, or be put in prison or other harsh penalties if they can show that you approached them and without a pre-existing relationship and you were unaccredited.
Well, once a deal's officially closed, are you free to now talk about the deal after it's no longer?
It's a gray area. It's a gray area.
Why is it a gray area? Because
different lawyers will argue different ways, but some lawyers will say that by talking about your previous deals, you're advertising your future deals. And there have been cases that have been brought up along those grounds that have been lost and won.
Really?
And so,
okay.
So it's there, in SEC law, you'll find a lot of areas that are actually fairly nebulous. They're not well defined, and so people tend to kind of skirt to an extreme to make sure they're not messing up. Hey, you have anything to add there, Adrian?
Yeah, I would just say that at the top, I actually was saying that the way to be in compliance is to establish a relationship with that person, and so that's also kind of a gray area as well. How can you say you have a relationship? Is it 2 phone calls? Is it have dinner with the person? It's really difficult to define that. But generally, the law says something. The language is something along the lines of, multiple meaningful interactions, something like that. So I think that if you have interest in something that a particular person or sponsor is doing, and you want to invest in that as a non-accredited investor, I think just establishing a relationship with that person is plenty. And we've had that. And I've had people approach me, by the way, and Danny, you probably have had this too. I've had somebody say, hey, my friend got in this deal with you guys. I'm really interested in being in this deal too. You know, can I also invest? And I always just set a phone call up with that person, and then I'll explain to them, you know, you can't be in this deal, but you know, this conversation is a great step towards the next potential deal. And so the rule is generally you have to have the relationship with that person before the deal is under contract. And so what I've done, or what I'll do, and I don't know if you've done this, Daniel, is you have those people that you circle back with and check in with, you know, when you're start to pursue the next deal, and hopefully they'll, you know, if they're interested in investing, great. So that's generally what our philosophy is.
There's also another thing that's talked about a lot with people that raise capital called the cooling off period. And that's another nebulous time frame. The cooling off period is once you have a couple of interactions with a potential investor, how long do you have to wait before you can present a deal to them? And different investors have different opinions on how long this should be. A lot of people, kind of a rule of thumb I've heard, is 30 days. Some people say 2 weeks. The SEC doesn't specify how long it has to be. But when you've had a meaningful interaction or two, oftentimes like an onboarding phone call or you know, meet and greet or something like that, there's usually some time period that has to elapse, you know, and that's going back to Adrian saying, hey, the next deal is probably more appropriate. But that's called a cooling off period, and it's pretty common.
Yeah, it's very common, especially once you start having a little bit of an investor footprint.
Thanks.
All right, I'll go ahead and end the call. Adrian, let's connect maybe in a week or so where I'm a little more vocal.
Yeah.
And thank you for stepping in. It's a really good talk. I enjoyed it.
Great, thanks. I hope everybody enjoyed, and again, happy to talk more. I love getting in the weeds. So if there is an opportunity to go start talking about defining all these terms and all these things, I'm definitely interested. So I'll follow up with you. Thank you guys very
definitely.
much.
Bye.
Okay.
Thank
Have a
you.
great weekend, everybody.
You too.